Hey, big question, Singapore. Is DBS still the king of kopi-money dividends, or will Fed rate cuts spoil the party? Stick around with me till the end, because we're going to unpack DBS Bank's third quarter 2025 results, its 5.6% dividend yield, and how global rate cuts could affect your passive income in 2026. And if you find this helpful, hit like so more Singaporeans can watch, learn, and grow their income. And subscribe to Wealth for You for more weekly dividend updates that'll keep your Kopi fund flowing. Alright, quick disclaimer here. This video is for educational purposes only. It's not financial advice, and not a recommendation to buy or sell any securities. All information is based on public DBS announcements on the SGX website and my personal interpretation for learning purposes. Please always do your own due diligence or consult a licensed financial advisor before making any investment decisions. Chapter 1. What dividend investing really means. So, what does dividend investing really mean? Well, dividend investing is simple. You're not chasing short-term price jumps. You're buying solid companies that pay you regularly while you sleep. That's what I call kopi-money investing. Here in Singapore, dividend investors love banks, REITs, and blue-chip stocks because they provide consistent income, perfect for covering your kopi, chai fun, and even those family weekend treats. The real goal? Build cash flow freedom, not just paper riches. Chapter 2. What does DBS actually do? Now, what does DBS actually do? DBS isn't just our local bank. It's Southeast Asia's financial powerhouse, managing more than $880 billion in assets across Singapore, Hong Kong, China, India, Indonesia, and beyond. It earns mainly from three things. First, net interest income. That's the gap between what it earns on loans and what it pays depositors. When rates rise, this gap widens. When rates fall, it tightens. So that's why DBS watches interest cycles closely. Second, fee income from wealth management, credit cards, insurance, and investment banking. As Asia's middle class grows richer, these businesses bring in more stable income even when interest margins shrink. Third, markets and treasury income, helping corporate and institutional clients hedge currencies, manage cash, and invest globally through DBS's strong trading desk. Oh, and DBS also leads in digital innovation. It was among the first to launch tokenized bonds, experiment with AI-powered customer service, and build an end-to-end digital-only bank in India and Indonesia. So, in short, DBS isn't just a traditional savings bank. It's the region's financial engine, driving Asia's next wave of digital and wealth growth, all while keeping its Singapore roots strong. Chapter 3. DBS Q3 2025 Financial Highlights. For the quarter ending 30th September 2025, DBS once again delivered a record set of results. Total income hit a new high of 5.93 billion Singapore dollars, up 3% year-on-year, powered by strong fee and trading income even as margins narrowed. Profit before tax also reached a record 3.48 billion Singapore dollars, rising 1% from a year earlier, while net profit came in at 2.95 billion Singapore dollars, dipping slightly, about -2%, mainly because of higher global taxes. Despite that, DBS maintained an outstanding return on equity of 17.1%, which is, far above most regional banks. Its net interest margin eased from 2.11% to 1.96% as global rates started to soften. But this was cushioned by strong deposit growth and hedging. Asset quality remained resilient. The non-performing loan ratio stayed flat at 1%, with allowance coverage of 139%. Capital ratios stayed robust too, with a CET1 ratio of 16.9%, giving DBS one of the strongest balance sheets in Asia. And for shareholders, here's the best part. DBS declared a total dividend of 75 cents per share, comprising 60 cents ordinary and 15 cents capital return. The ex-dividend date is Thursday, 13th November 2025, and payment will be made on or about 24th of November 2025. That extra capital return component signals confidence. DBS is rewarding investors for its record performance while managing down excess capital in a disciplined way. In short, even with softer margins, DBS's Q3 numbers show a bank that's still growing profitably, protecting asset quality, and sharing the rewards with its shareholders. Chapter 6. Is DBS overvalued or undervalued? Now let's talk about what every investor wants to know. Is DBS cheap, expensive, or somewhere in between at its recent closing price of $53.50? DBS currently delivers a strong return on equity of about 17%, reflecting how efficiently the bank turns every dollar of shareholder capital into profit. Its price-to-earnings ratio sits around 13 times, meaning investors are paying $13 for every $1 of earnings. And with a price-to-book ratio of roughly 2.2 times, DBS trades at more than double its book value, far higher than many global banks that still sit below book value. Why the premium? Because DBS deserves it. It's consistently profitable, conservatively managed, and far ahead of most peers in digital banking and innovation. Those strengths justify investors paying up for stability and steady growth rather than volatility and surprises. So, at $53.50, DBS doesn't look like a bargain bin stock, but it's not overpriced either. It's fairly valued to slightly undervalued, especially for long-term income investors who appreciate dependable dividends and a proven franchise. In short, not a quick flip play, but a solid kopi-money keeper for patient Singapore investors. Chapter 5. Trailing and Forward Dividend Yield. At DBS's 5th November 2025 closing price of $53.50, the dividend numbers really continue to stand out for income investors. Based on the past 12 months of payouts, the trailing yield is about 5%. If DBS maintains its current policy of 75 cents per share every quarter, which is made up of 60 cents of ordinary dividend and 15 cents of capital return, that annualizes to $3 per share, giving a forward yield of roughly 5.6%. That's a healthy kopi return, comfortably higher than most fixed deposits or Singapore savings bonds today. For many investors, DBS remains a cornerstone of reliable cash flow. Now, let's talk about sustainability. DBS generates more than 8.6 billion Singapore dollars in net profit annually, supported by a strong balance sheet, a CET1 capital ratio of 16.9%, and a non-performing loan ratio of just 1%. These are among the strongest in the region. However, it's worth noting that with the current total dividend of $3 per share, the effective payout ratio is closer to 70 to 75% of earnings, not 50%. The lower figure applies mainly to DBS's ordinary recurring dividend of $2.40 per share. The extra 60 cents a year is a capital return dividend, funded from retained earnings as the bank optimizes its excess capital. Management has guided that 2026 profits may ease slightly as interest margins compress, but with robust capital and stable credit quality, the overall dividend looks well covered and sustainable in the near term. So, while dividend growth might pause, the flow itself is steady. For Singapore income investors, DBS's yield remains one of the most dependable kopi streams in town. Chapter 6. DBS's future prospects and Fed rate cuts impact. Looking ahead, DBS continues to show why it's the cornerstone of many Singapore income portfolios. even as the global rate environment shifts. The good news is, the bank's wealth management engine is booming. Fees have climbed 31%, and assets under management have reached record highs as more clients across Asia turn to DBS for advisory and investment solutions. Its deposit base remains one of the strongest in the region. With steady CASA inflows, DBS enjoys a large pool of cheap and sticky funding, which helps cushion any margin squeeze when interest rates fall. On the technology front, DBS continues to sharpen its digital edge. From using AI to streamline operations to pioneering tokenization projects that could transform how assets are issued and traded. These innovations not only cut costs, but also position the bank for the future of finance. And let's not forget capital strength. With a CET1 ratio of 16.9%, DBS holds more than enough reserves to maintain healthy dividends, and possibly even consider future share buybacks when conditions allow. But there are some headwinds to watch. The Fed's expected rate cuts into 2026 will likely push down SORA, Singapore's key interest rate benchmark, which in turn could squeeze DBS's net interest margin and reduce interest income. A stronger Singapore dollar also has its downside. Overseas earnings, especially from Hong Kong and Indonesia, translate into fewer dollars when converted back home. And if global markets turn volatile or regional growth slows, non-interest income from trading and investment activities could soften as well. DBS has already guided that its total income in 2026 will likely stay around 2025 levels, with net profit expected to be slightly lower. However, fee-based businesses, especially wealth management and treasury sales, are expected to keep expanding, providing a steady counterbalance to softer lending margins. So while your kopi-money may not grow much next year, it's not drying up either. The stream remains steady and dependable, and for income investors, that's gold stability through cycles, backed by one of Asia's most resilient banks. Chapter 7. What Singapore income investors should consider. Before you decide whether to buy, top up, or simply hold your DBS shares, here's an important reminder. Now, let's wrap this up with what income investors should realistically consider. DBS remains a core blue chip in any Singapore dividend portfolio. A bank with deep roots, strong governance, and a consistent record of sharing profits through dividends. But like every investment, it's not without its cycles. Heading into 2026, growth will likely flatten as global interest rates fall and net interest margins tighten. The kopi-money may flow at the same pace rather than growing, but stability is the name of the game. If you already hold DBS, you may choose to continue focusing on the steady dividend flow as part of a long-term income strategy. For those learning or starting out, many investors use approaches like dollar-cost averaging, investing gradually over time, or adding during market weakness, to smooth out short-term volatility and build consistency. Final thoughts. DBS in perspective. To sum up, DBS has brewed another strong quarter. Record income, resilient credit, and one of the healthiest balance sheets in Asia. Its strengths lie in world-class digital innovation, a powerful deposit franchise, and a rock-solid capital position that supports both dividends and confidence. The risks come mainly from the macro environment, rate cuts compressing margins, a stronger Singapore dollar reducing overseas profits, and regional slowdowns that could affect fee income. But here's the big picture. Even as the winds shift, DBS stands tall as a cash flow champion, resilient, adaptive, and rewarding. At 6th November 2025, closing price of $53.50, the stock looks fairly valued, offering a yield that still beats most alternatives in the market. For long-term Singapore income investors, DBS remains one of the few stocks that can weather rate cycles and still keep your kopi fund flowing, quarter after quarter, year after year. If you found this breakdown helpful, Like this video so more Singaporeans can learn how to build smarter, steadier income portfolios. And subscribe to Wealth for You for more dividend insights every week. Till next time, may your dividends flow as smoothly as your morning kopi.